When you take a look at the Goldilocks, like what a new Goldilocks means, in your world, what does that mean?
Well, we've spent the last 10 years watching policy rates around the globe come down. We've got growth, positive, but actually relatively low if you look at it against an historic context. And what's been rather interesting is asset markets have massively outstripped, in return terms, both the level of GDP growth and, to a degree, the level of wage growth around the world. So we've got this kind of interesting scenario where asset markets have gone a long way ahead of what we might have reasonably expected. Now, David in the previous segment talked about the notion that we're running out of road on monetary stimulus. Mm-hmm. So if and when we do go through the next downturn and into the next cycle, what's it going to look like? Are we going to get a repeat of the situation of low growth and low rates? Well, there's an argument actually that with policymakers having run out of road from a monetary standpoint, do they do something different? Do we see more of that fiscal boost coming on? Christine Lagarde's been talking about it in Europe. We've seen it happen in the United States. Is this the new piece of the toolkit? Were that to be the case, it presents an upside risk, both to rates and to the shape of yield curves. But for that to run through appropriately, what we effectively need to do is use it to rekindle animal spirits. And that's where really, having listened to Charlie Evans in the basis of where does productivity come from, we're firmly of the view that it's a long-run issue, but it does take a degree of sentiment boost, confidence, etc., as well as capital investment in order to rekindle it. There's a great opportunity out there from productivity. It's low around the globe at the moment, and that's the upside risk case. So can we bear higher rates in the next cycle? Possibly, but provided we get a different policy mix going into it.
When you talk about fiscal stimulus, that's a pretty big umbrella, and obviously there's a lot of risks entailed with that as well. So what does smart fiscal stimulus look like to you? What would actually help revive those animal spirits?
Well, I think, it's going to be varying country to country. Within Europe, the question mark is, does this become part of the greening of the economy, something which is obviously very much at front and centre, both of the political economy, but also of forward growth? Does it involve greater access to technology, build out of 5G, investments in infrastructure that are going to carry us into the next period of growth uplift? So the question really comes down to working out how do you use fiscal, not in a way that you simply throw money in a hole, but how do you use fiscal to actually invest in the future? And I think that the conversations that are happening today, brought about in part by being forced through running out of road from a monetary stimulus standpoint, means that the conversations that are happening right now are the right ones to be having. Does that mean that tomorrow we're going to see, fiscal space start to be used up? Probably not. We argue within the paper that it will probably take some sort of shock to really direct attention on this. But the reality is, we do think in the next upswing, it's going to be part of the toolkit that policymakers use.
But and I think the other thing that's really important here in terms of the difference between fiscal and monetary is monetary stimulus tends to lead to more inequality, tends to suppress rates, suppress inflation. Fiscal stimulus, particularly if it's sort of directed by left-wing populists rather than right-wing populists, could well have the opposite impact, because one of the reasons we don't have much aggregate demand, we don't have much inflation here, is because aggregate demand is when people with money want to buy stuff. The problem is the people who have money don't want to buy stuff, and the people who want to buy stuff don't have money. But if you have a sort of a cut in taxes for lower income individuals, earned income tax credits, a lot of direct government spending, suddenly you can get that aggregate demand, which leads to a higher inflation, higher interest rate outcome.